The candlestick signals allow investors to see what's actually happening in the overall market. As we can see what happened here in the Dow a couple weeks ago, we started seeing sell signals right at the obvious resistance level. That told us we shouldn't jump out and definitely go short. What it told us was that there was starting to be some weakness in investor sentiment, that if you started seeing your long positions starting to roll over, you could be shorting or closing out those positions and adding to short positions. Because during that time frame, the NASDAQ was still trading higher, indicated that we didn't necessarily jump out of long positions on a 10-position portfolio, jumping from having 8 long positions to all of a sudden having 8 short positions. That process was developed over a period of time where the NASDAQ was telling us that there were some sectors still heading higher, while the Dow and S&P 500 were telling us other sectors are heading lower. The whole market did not tell us it was selling off at one time until we saw, with the other indexes trading lower, the NASDAQ doing a bearish engulfing signal, and then on Friday closing below the T-line. That close below the T-line was a good statistical indication that if the NASDAQ was starting to close below the T-line and the other indexes were heading lower, that the probabilities were pretty strong that we were going to be heading much lower. So establishing short positions didn't occur all at one time. As we can see in our recommendation to go short an OLED, was based upon a little left-right combo gap down, breaking this downward or this support area, and it never has come back up above the T-line. Our recommendation to go short on SGMS was based upon a bearish engulfing signal, another bearish engulfing signal, and it started to stay below the T-line. Where do most people sell? They start panic selling at the bottom. Having been already established in the positions on the short side, the candlestick investor can take advantage or gets the benefit of the hard sell-off, and knowing where we are in the trend with stochastics in the oversold area, be a little bit more prepared for taking profits in short positions. Our recommendation to short LCI was based upon a dumpling top and then the gap down or the trading below the T-line. Again, all these positions weren't added all in the same day, but as the general market or the Dow started showing weakness and the NASDAQ was still trading higher, we still had long positions on, but over time we were adding more and more short positions. And a major benefit to candlestick scanning techniques is it allows an investor to identify where there's buying in specific stocks or sectors as well as selling. As we can see in INNT, we've got a nice slow curve breakout through the 50, gapping up, giving us the prospects of more upside, even though the market was trading off 300 points on the day. Candlestick analysis is merely the graphic depiction of what's going on in investor sentiment, and the Japanese race traders have provided the illustrations for what is happening in investor sentiment based upon signals and patterns that they identified over the last 400 years. That'll be it. We'll see you in the chat rooms.